Joe said and others have said, people didn't want to look at the Bloomberg terminals. They wanted to look at the AAA rating. And they just did, it became, I don't want to think about anything, just tell me it's AAA. Again, some relief is in this new legislation. Joe talked about the fact that there's too much dependence in the law on credit rating agencies, and the bill actually strikes the need for credit rating agencies in a lot of different pieces of law.
It does, yeah.
And transfers using reasonable prudence, your own reasonable prudence, in deciding. You may need analysts, you may need to do your own thing, but you've got to decide what these things are worth. And as a former litigator of 25 years, I have a lot of confidence in one thing they did was they created a private right of action for people to be able to sue credit rating agencies for negligence in establishing the credit ratings. And that, I believe, is going to impose a discipline on them that they have heretofore not felt.
Question for Mr. Soros and Professor Warren. Bert Flickinger, our family's been in manufacturing, transportation, and retailing in this country over 3 centuries. And Mr. Soros, you mentioned that the banks are way underfunded in Europe. What's your collective forecast for the US, given that the banks are way underfunded for residential real estate, for commercial real estate, and most major manufacturers that we know that have unions, in addition to transportation companies and retail companies, have pension plans that are facing insolvency the way the stock market's going. So you have 200 banks going out of business, and you have banks that can't pay for their underfunded sovereign debt internationally. They can't pay for their underfunded debt nationally, and they have this ticking time bomb of pension plan debt that's going to blow up. And how much longer do you see the tough economic times ahead, given this underfunded payment liability, both publicly and in the private sector? Thank you.
Well, I think that the American banks generally are in better situation than the European banks by comparison. But they still have some unresolved problems, particularly in commercial and maybe to a lesser extent in residential real estate. And that's what makes them very reluctant to lend. Now, they are earning their way out of a hole much faster than the Japanese banks did, because the yield spreads are much, the yield curve is much steeper. They can borrow at practically zero interest, and they can invest it in, let's say, 10-year government, or let's say mortgages at 4% or so on. That's 3% spread, or more than 3% spread. The Japanese, in the case of Japan, the spread came down to 1%. So they're earning their way out faster, but even so, it will take a few years for it to happen, and those are going to be years of stagnation. And if we overdo it with fiscal prudence, then actually you could conceivably have a double dip.
I would only add to that, that although I did not ask your question about the pension funds, if you take a look at the most recent Congressional Oversight Panel hearing with Secretary Geithner, I had 2 rounds of questions with Secretary Geithner in which basically I asked that same set of questions. And he said he's confident that it's not a problem. I love usury questions. If you want to understand the American consumer financial system, let me give you the thumbnail sketch. It has 3 periods. The first period in history goes from the 18th century BC to the Code of Hammurabi. I'm serious about this, which has usury in it, on through Deuteronomy, other books in the Bible, serious Bible scholars, on to colonial Europe, colonial America has it, because the whole point of the consumer agency, and really think about it, you got 2 paths. You can try the usury path. It's blunt, and it has some pluses and minuses, or you can go the agency path if the agency does its job the right way. And if the agency does its job the right way, it's about products that people can see, read, and understand. 2-page credit card agreement, terms are right out there where you can see them. You can put 4 of them on the table in front of you and say, that's the one that's the cheapest. Read it in 4 minutes with 90% comprehension, and by golly, that's a whole new market for the consumer credit folks. So, 3 periods, I hope.
You know, the first really sleazy credit card operator in the United States was Providian.
Oh, yeah. They
invented it. A guy named Andrew Carr created this whole market. And when they first started out, other banks, the banking industry was horrified by what they were doing. The hidden fees and the high hidden interest rates and what Elizabeth calls the tricks and traps. They invented the tricks and traps. And when they did that, the banking industry was happy with a return on equity of 8%, 9%. And one of the things that's happened is that the banking industry now wants a return on equity of 15, 16, 17%. They want to be high growth. And the only way you can do that, if you're a consumer banker, is to screw your customers. I'm sorry, but that's pretty much the only way you can get at that kind of, because banking is not a business like Google that naturally generates a high return on equity. It generates a low return on equity. So, you know, nobody is talking about, you know, the country needs a kind of reset, which we're not probably going to get, but you know, people need to, they need less debt, and they need to think about the equity markets and the bond markets in a different way, and they need a reset in terms of the expectation of what a reasonable profit is and what a reasonable return on equity is for a bank. And, you know, nobody really talks about that, but we did just now. Who's got the mic? I feel like I'm on some game show. Yeah, there are people, a lot of people up here with hands up who are not getting a shot at it.
I'd like to direct this question to the entire panel regarding the question now of extending unemployment. And I want to predicate it by, number one, how real is the number? Because we've seen another graduating class that, of course, to apply for unemployment insurance, you have to have once been employed. And we have an entire graduating class year after year that's coming out not finding a job, so therefore ineligible for unemployment. And this may not relate directly to financial markets, but I wonder the effect of not extending those credits. As an example, a 2-income family that's maybe struggling to keep that mortgage paid, as Elizabeth spoke about earlier, with the amount of foreclosures that are hitting the market, and maybe they're just squeaking by because one of the members of the family is getting unemployment and one is employed. Now, if we pull that unemployment insurance away from them, could it make our foreclosure system even worse? Just when we think we're coming out of it, this gets pulled out, and it affects it specifically regarding foreclosures. But I wonder how a failure to extend unemployment, considering the job rate, you know, the jobs aren't there yet, will affect the entire financial markets.
Well, I think you've hit the nail on the head. I mean, and that's what, you know, even Larry Summers wrote a piece recently essentially articulating the view that by not extending these unemployment benefits, you're going to have defaults not only on mortgages but credit card debt and everything else, which will trigger all sorts of complications because of the securitization process and the betting process and everything else. I frankly think worse than, and believe me, I'm working with a lot of members of Congress who are fighting very hard to get this unemployment insurance extended, and I'm very committed to that. But what really bothers me